Very good morning, everybody. Can you hear my voice and can everybody see the screen? Can you confirm to me that you can hear me fine? You can see the screen. Great. Welcome to Pathfinder Trainings, guys, and good morning to everybody. I am Yogeshwar Vashishtha, your instructor for the day, and I thanks technology. Here I am sitting in my office, and there you are sitting in your homes, and we can still talk to each other, and we can exchange things, and I can teach you something about the stock market, whatever I know. So let's start. Most of you are already here, guys. So let's start the session. Today we'll be talking about trading for a second source of income. So are you here for the stock market today? Apparently, it might look that you are here for the stock market, but basically, you are here for money. It is the money that the stock market promises, which brings most of the people into the stock market. But money is there in lottery also. But lottery can't run your house. Why? Because it doesn't promise consistency. So we are not here only for money. We also come to the stock market to look for incomes. And this is very important to understand that only when you come to the stock market to create incomes can a stock market be a fruitful place for you. What is the difference between money and income? Income is that money which is consistent in terms of amounts and in terms of frequency. For example, your salary is an income. Why is salary income? Because you know how much you will get and you also know when you will get it. That means you can plan your life, you can plan your expenses based on the income that you will receive. So it's critical that to fulfill your financial need, you have incomes. So when we come to the stock market, we need to create incomes here, and that is one thing which is very, very important to understand. One thing lacking in the market by most of the people is patience. You put your money into a LIC policy, keep on paying premiums, year after year for 20 years, 30 years, and what are the kind of returns you get into LICs? About 6 to 7% a year. People put money into FDs for longer periods, 6 years, 7 years, and what is the return on the capital? Maybe about 9% a year. But when people come to the stock market, they want to become rich now. They want to make money very, very fast. And this is where the problem lies. If you have to create incomes, then you have to give sufficient time to develop the skill to create that income. For example, at this moment, let's say you have an income, your salary of about 1 lakh rupees a month. Ask yourself, how much time did you spend to create that skill? You went to the school, you went to the college, then you did a specialization. This itself took about 20 years. Then you applied for a job, got an interview call, went for the interview, got selected, and you did not start at 1 lakh rupees a month. You started maybe at a little lower than that, and then gradually over a period of years with your hard work, you got your promotions, you got your raises, and that's how you are getting your 1 lakh rupees a month. So then you spend about 30 years to create this income of 1 lakh rupees a month. And this is exactly what the attitude should be in the stock market. And please understand, stock market is a new subject for most of the people. It is not taught in your schools. It is not taught in your colleges. There are no reputed institutes teaching it. And most of the knowledge people have about the stock market is either from their peers, their friends, their parents, or from a stockbroker, from a book, or from a TV channel. So that's why most of the people are not very skilled when it to. So today we'll be talking about how you can have a whole new skill of making money. You know, we all require skills to make money. Without skills, you can't make money. Whatever job you do, you have acquired that skill. So why not have one more skill of making money? Most of us have only one skill of making money. And if something happens to that skill, then we have nothing to fall back on. So when you come into the stock market, take it with the attitude that you have to develop a new skill of making money, and any skill, requires that you give it sufficient time to practice and to learn it. What is skill? Skill is transfer of knowledge from conscious mind to subconscious mind by practice, practice, and practice. For example, I'm speaking now. You're listening now. A language, we are talking in English. This is a skill. We were not born with the ability to speak or listen English or write English. It is an acquired skill. Play a game, cricket, tennis, football, acquired skill. You learned it over a period of time. Even a very simple thing like driving a car is an acquired skill. You were not born with the ability to drive a car. At some stage, you went to a motor driving school, paid them the required fees, committed the required time. They gave you an instructor who took you on a road. And, in the start, he said, drive slow. First gear, 10 kilometers an hour. Why? Because he knows that you don't have the skill, you don't have the practice. So first thing he teaches you is the brake. You start on a real road in a real car. From the front, a lot of traffic is coming. And what is the first emotion you experience? Fear. Lack of skill creates fear. And you very slowly start, you're afraid, you're scared. You feel as if every car coming from the front is coming to hit you. But trust me, the people outside are more afraid. Because on the back of the car is written, driver shikata hai. And, because you don't have skill, you are scared. But within a few days with practice, your left hand knows how to put the first, second, third, and the fourth gear. Your two legs know how to make the right coordination between the clutch, brake, and the accelerator. And within a few months, with practice, you are driving on a highway at 60 kilometers an hour and enjoying your drive. Why? Because with practice, you have acquired the skill. And when it is on the level of a skill, your conscious mind is not involved. And that's the level to which you will have to bring this market if you want to make sufficient incomes from this market. The first challenge that you face in your day-to-day life, and that's the reason you are looking for a second source of income, is inflation. What is inflation? A continuous devaluation in the purchasing power of your money. In our country, the inflation is about 15% a year. This is average inflation. Look at the things you consume on a daily basis. Milk has gone from about 10 rupees a liter to 40 rupees a liter, inflating at about 20% a year. Your fuel cost has gone from about 25 rupees a liter in the last 6-7 years to about 65 rupees a liter, inflating at about more than 15% a year. Travel is inflating, your children's education is inflating, everything is inflating. What does it mean? And that's what the rule of 72 says. 72 divided by the rate of inflation is the number of years in which your purchasing power will become half, and you will require double the amount of money just to have the same purchasing power. Remember, an engineer in 1960, what he used to earn is about 1,000 rupees a month. An engineer in 1990s used to earn about 10,000 rupees a month. And an engineer today maybe earns about lakh rupees a month. All these three have exactly the same purchasing power. And that's why over a period of time, your incomes have to increase if they have to beat inflation. At an average inflation of 15% a year, every 5 years your purchasing power will become half. For example, if you are 40 years of age now, and you earn about 50,000 rupees a month, and that takes care of your home, your loans, and other things. At the age of 45, you will require 1 lakh rupees a month just to have the same purchasing power. At the age of 50, you will require 2 lakh rupees a month. At the age of 55, you will require 4 lakh rupees a month. And at the age of 60, you require 8 lakh rupees a month. And your source of income will become zero because you will retire, and most of us do not have pensions anymore. So why not have a skill where even after 60, you can sit at home and you can make money? And that's what we are going to learn today. We'll learn how to make money with intraday trading. How if those of you read Hindustan Times, we have this story on the front page today, how a lady in Delhi, makes very good amount of money from intraday trading after she has left her job, more than her salary. Then we'll learn how to catch the market swings with swing tradings, how to build and manage your portfolio over a period of years, how to trade leverage assets like stock futures, index futures, options, commodity, and Forex, and very important, how to make money when the price goes down. Most of the people have no idea how to make money when the price goes down because they equate downward movement with a loss, because they don't know anything about the leveraged products. They only know how to trade stock. And that's why a husband doing intraday trading in stocks for the whole day, 3:30 the market closes, husband comes home, and just by looking at the face of the husband, the wife can tell whether the market went up or the market went down. So we will learn how not to be at the mercy of the direction, how you can make money in both the direction. And if you can make money in both the directions in this market, then you don't really have to bother whether it will go up or it will go down. And that's a very important part of the that we will be learning today. Let me introduce myself in brief. Friends, my name is Yogeshwar Vashishtha. I'm a geotechnical engineer by profession. I've done my M-Tech from IIT, my international certification in management from South America, and my advanced course in trading from Pristine Academy of USA and Online Trading Academy of USA. I'm a professional trader and a mentor. This is what I do for a living, but I did not start my life as a trader. In fact, in my house, nobody was a trader. Nobody was a trader in my house. I finished my M-Tech. After that, I was a scientist in CBRI for a few years. Then I joined an international company, Skanska, and went out of India. My specialty is hydropower projects, and I have made hydropower projects in many countries in the world. And two prominent countries where I have made hydropower projects are Sri Lanka and Peru, and some stints in Sweden. So this is what I was doing in the start of my career. Went out of India. I was the NRI for many years, making hydropower projects. Then got married, had two boys. They started growing up. And when I was in Sri Lanka, I realized that this life of jungle, that's where hydropower projects are, would not be good for my family life. And I started thinking of coming back to Mumbai. But then I realized I have no other skill of making money. And a skill that was giving me good money in the jungles was absolutely not much of use to me in a city. And I started thinking of a new skill by which I could make money from the markets. And a friend of mine, Johan Nopp from Sweden, he suggested, I tried trading. But trading, I had very negative connotations about trading. My father is a scientist, now retired from Indian Institute of Petroleum. And he always said, stay away from smoking, drinking, stock markets. And I asked him why stock markets, and he said because stock market is gambling, and this is a concept that I didn't, check whether it was right or wrong. That was the concept I had in my mind. And when Johan talked to me, I said, well, I've heard that this is gambling. He said, no, it's not gambling. I'll introduce you to a Swedish trader. And he introduced me to a Swedish trader in Colombo. And he, gave me a book to read, Trading for a Living by Alexander Elder. And that was a turning point in my life. The Swedish trader, he became my first mentor. And under his mentorship in the jungle of Sri Lanka, I started learning the stock market. And the first thing that he taught me was that this market is driven by fear and greed in the short term and by the balance sheets in the long term. So the technicals govern the market in the short term and the fundamentals govern the market in the long term. He said, if you want to make money here, you have to learn how to buy people's fear and how to sell people's greed. This is lesson number one that I got from him. So a lot of things I learned from him. From there, I was transferred to South America. I was in Peru making the Yuncan hydropower project. And there I had the chance to learn from one of the best trading schools in the world, which is Pristine Academy of USA. And there my learning went to the next level. At the time, I used to trade a ICICI direct account, and a friend of mine used to send me research reports from Sher Khan. Sher Khan always had brilliant research reports. And after I came back to India, I started trading through them. So here in Pristine, I started learning some very important lessons. And few things that I learned, one of them very prominent is that this is not a business of being right. You don't have to be right all the time here to make money. Your loss-taking capacity is limited, and the market's loss-giving capacity is unlimited. So you have to trade with risk management. With proper risk management, you have to trade, and you have to limit your losses into this market. So learned a lot from them, started trading the markets part-time, and started giving me good results. And by 2007, when I was transferred to Scotland, that's what the next project where it was coming, and I decided to quit and come back to India. I came back and I became a full-time. At that time, the Indian market was booming. It was going up. Indian market was booming at that time. 2007, big rally. And it was easy to make money in that market. Then came 2008. And in 2008, our market crashed. 2008, our market crashed. And a lot of people, they were devastated. Big losses happened, in the market in 2008. And, that year turned out to be my best year because there was a great opportunity in 2008 to make money, in the market going down. And how does that happen? Because there are instruments in which you can make money when the price goes down, and we will see them here. So 2008, 2009, I practiced both the long sides and the short sides of the market. And by 2009, I knew this is what I want to do for the rest of my life. And gradually, a group of traders started gathering around me. I stay here in Mumbai and Thane. And within a period of about a year, from 2009 to 2010, I had trained more than 1,000 people, who was trading under my mentorship. In 2010 end, an international company came to India, and they approached me, and some consultancy I could give to them from end of 2010 to the mid of 2012, and this was one among this group of international traders. Brilliant team of traders here. Wonderful learnings, wonderful teachings here. And, this 1.5 years with this group was, a great learning experience for. By 2012, I started toying with the idea of creating a mentoring model of my own. So, left this group in August 2012, had great learning from them, and started working on a mentoring model of my own. And in December 2012, I started with, a mentoring model of my own, and trained a group of about 35 people. And since then, in introductories like this, online and physical, more than 5,000 people have been trained. And in my main workshops, roughly about more than 800 people have been trained here. So, and this is my company, Pathfinder Trainings, where we teach people how to take trading as a profession, not as a gamble, as a profession where you can make money. Guys, just a minute. Some people are complaining sound is breaking. Just give me a minute. Okay, guys, is it better now? Can you hear me better now? Can you just give me a confirmation? Okay. Fine, guys. So, this is what we do, and this is what we are into. And let's go on some trading myths. Before I come here, let's look at a chart. This is the market on Friday. The market went up about 19 points. And if I open the chart here, this is the index, our market, the Nifty, in the last about a month or so. If you look in last 1 month in this market here, you see market has gone up, then it has come down. Market has gone up, then it came down, then it goes up, then it is coming down here. So one thing we know is it doesn't go up forever and it doesn't come down forever. That means you need to have a skill of making money when the price is going up, but very important, you also need to have the skill of making money when the price is coming down. So, if I'm looking here on this one, that means I need to make money in both the direction. Let's look at a particular stock. Let's see here. I have on Friday, PNB, Punjab National Bank, went down 2.38%. So if I look at PNB, if I'm looking at PNB here, PNB went down 2.38%. If you were trading the stock of PNB, you would have lost 2.38% here. You would have lost 2.38% if you're trading the stock of PNB because it went down. So, was there a way you could have made money in PNB here? Yes. If I go to a different product, let's say I go into Punjab National Bank, then I go into this near contract, put options. So, and I look at especially 200 puts here. I see the 200 put option on the same day went up 38%. That means on the same day, when in the stock of PNB, you lost 2.38%, in the option of PNB, you could have made 38% in a single day in PNB. How's that? And that's what we'll be learning about today a little more. So you can make money in both the directions into this market here. That's very important to understand. But let's go through some myths first. The first myth about this market is that trading is like gambling, that you just come here and you gamble. Gambling is not what trading is. What do you do when you're buying 100 stocks of, Tata Steel? What are you doing? You are giving money to Tatas to do business on your behalf. That's what you're doing. You are giving money to Tatas to do business on your behalf. When you're buying stock of Infosys, you're giving money to Infosys to do business on your behalf. So you are partners in a business. And आंसर मी सिंपल, वेरी छोटा सा सवाल पूछिए, यदि आपको किसी बिजनेस में अपना पैसा इन्वेस्ट करना है, so won't you first check out whether that business is viable or not? Is the product attractive? Is the business profitable? Is that business having a future? Is the management okay? How is their competition? How do they handle the competition? So only after doing your due diligence, won't you put money into the business? So exactly the same thing is there into the stock market. What is stock market? Stock market is a place where there are 5,000 businesses belonging to different sectors. And each business won't be profitable. Some in the long run will become profitable and others won't be profitable. They will become loss-making businesses. You have to develop the skill and you have to do your due research to find out of these 5,000 companies, which one is likely to go up and which one is likely to go down. And if you can find that, then you can put your money into the companies which are likely to go up, and you can make money shorting the companies which are going down. So you actually are putting your money in the growth of the company. So you're not gambling. And since you do business, you have to learn the skill of doing the business. Second myth, I can trade based on news. No, you can't. News just creates volatility. And until unless you don't know what to do with that volatility, you won't be able to catch the direction of the market. The third myth is, I don't need any formal trading education. Well, to make ₹1 lakh a month, you have put in about 30 years of your life. So here you want to make 10% a month or more maybe. And, you have to train yourself and practice before this kind of money comes to you. In this market, one thing is very clear. People with proper education and training make money here. And people who are not educated and not trained here, they lose money here. Why? Because trading is a zero-sum game. Trading is a zero-sum game. For every buyer, there is a seller. For every buyer, there is a seller. Otherwise, this market won't exist. If somebody wants to buy PNB at 205, he wants to buy it because he believes that the price will go up. How about the people or the person who's selling it to him? Doesn't he believe that the price will go down? That means the transaction itself is based on a difference of opinion. So how can, you be right here all the time? So you need to train yourself. Others will make you rich. Nobody is going to make you rich here. And, you have to develop the necessary skill to make you rich. And here, nobody is even responsible. When you put your money into a FD in a bank at 9% a year, the bank guarantees it to you. But when you are, opening a trading account, a demat account, buying a mutual fund, giving money into a PMS, don't you sign yourself there? That if a loss happens, you are responsible for it. That means nobody else is responsible to give you money here. And that means that you have to learn the skill of making money yourself. This is another big myth of the market. Over a period of time, everything goes up. If I stay invested long enough, I'll make money. I just have to buy and hold my stock. This is the buy and hold myth, which doesn't work much into this market now. Why is that? Two reasons. Number one, all business don't become profitable. Maybe around 25 to 30% businesses are profitable. Rest over a period of time are not profitable. This is the history of businesses for hundreds of years. Second, in our market now, stock is not the only product. There are competing better products. They're competing better products into the market, and let's look at them. If I see here the trading volume on the National Stock Exchange this Friday. So let's see where the money was flowing. Equities, the traditional stocks. Guys, some of you, if you have a low bandwidth, you might be having a disturbance. You require about 1 Mbps. So don't worry, to everybody, I'll be sending a recorded link. So if in case your voice is a little breaking, please have a little patience. I'll be sending a recording link, so you can listen with that. So if I look on this one here, if I look at the equities, which are the traditional stocks, this is the National Stock Exchange. How many stocks are there on NSE? About 2,000. So 2,000 stocks combined together, the turnover on Friday was 19,227 crores. Now, if I look at index futures, which is just two are liquid, Nifty and Bank Nifty, and in just two of them combined together, the turnover was about 13,888 crores. So, why is more money flowing here? More money is flowing here because the index future is a two-directional product compared to stock, which is a single directional product. In a stock, you can make money only when the price is going up. But in an index, you can make money whether the price is going up or the price is going down. Other, quality of a stock is that you have to pay 100% of the money. No discounts here. You have to pay full money to own the stock because the ownership is for life. But when you are buying a future product, index future or a stock future or a commodity future, these are discounted products. Means to buy the index future, you only have to pay 10% of the total value of the contract. So, if I'm getting a 90% discount on a product, why would I, give full 100% money on it? And that's why indexes are becoming so popular, futures are becoming so popular. Then if I go to the stock futures, how many stock futures are there on NSE? About 150. And in just 150 stock futures, the turnover was 26,949 crores, about 35% more than the turnover in 2,000 stocks. And if I come to currency futures, which are only four, USD, INR, Euro, INR, 4 pairs. Just in 4 pairs in which USD, INR is the most liquid, the total turnover was about 14,000 crores. And then there is a commodity market which has even a bigger turnover. So, we see that out of the total money that flows into the market, only about, 20% of the money flows into the stocks. And in which stocks will it flow? Which are fundamentally strong, fundamentally sound. And that's the reason, Only fundamentally strong stocks will go up over a period of time. Others will go down over a period of time. That's why for every one stock going up, you will find about three stocks going down because money is not flowing into all the stocks now. And that's why they don't always go up. Name is not good enough. Let's look at this buy and hold theory. Let's look at some of the blue chips. Suzlon, about 7 years ago, used to be at about 450 rupees. Today available at about 14 rupees. You have lost 90% of your hard-earned money just by staying invested over a period of time. So, what are the two things that you lose? You lose the actual money, plus you lose the opportunity. This is finance, one of the bluest of the blues. And in the last about 6 years, you have lost about 50% of your money in this. And I'm talking of a blue chip. So if you would have put that money at least into a FD, you would have made your money double. So what you lose is not the 50%. What you lose here is 150%. The 100% of the opportunity cost and 50% of the actual loss that you are having here. Arcom from 900 rupees now down to about 82 rupees. DLF from 1200 rupees down to about 140 rupees. You've already lost more than 85% of your hard-earned money. And when it will go up, what is the chance of it going up to 1300? Very bleak. Please understand. If you lose more than 50% in a stock, it has to go up more than 100% for you to just recover your money. And nobody can compensate you for the time that you have lost. In this market, you not only spend your money here. In this market, one thing that you spend and you never get back is your time. In your job, you get paid for your skill and your time both. So here also make sure that you are paid for your time. And when you hold a losing stock for a long period of time, you spend a lot of time without getting paid for it. Kingfisher going down. People ask me, sir, ये stock जाके कहाँ तक जा सकता है? What is the maximum this stock can go down? I said, oh, that I can tell, zero. Because every stock can become zero. That is the potential. Whether it becomes or not is different. But every stock has the potential of becoming zero. Make sure yours doesn't. And over a period of time, you can lose a lot of money if you don't know what to do here. BHEL going down. Jindal Steel going down. These are all big names I'm talking about. Really big names I'm talking about going down here. And it's already down from 840 rupees to 160 rupees. So, and once you lose more than 20% of the money in a stock, is very difficult to sell it. Because emotionally, you would never be in a position to sell it. JP Associates down. Tata Steel down. Financial Technology down. I can go on and on with this list. I can show you a lot of stocks like this. So if you are holding a stock like this, then the only strategy most of the people know is buy, hold, and pray. God, please make my stock go up. No. Prayer won't take it up. Your skill will. Unitech from 17 rupees to 550 rupees and down to 17 rupees. These are the monthly charts. And where do most of the people buy? Most of the people buy on top. A lot of people into this webinar today. More than 100 people are attending this webinar today. That's a big number. I'm really overwhelmed. Thank you very much for coming. But at this time, the market is on peak. So greed is the dominant emotion. How do we behave as human beings? We buy our greed, and we normally sell our fear. When we are greedy, we tend to buy. When we have desires, we tend to buy. And when we are scared, we tend to sell or not buy. And normally, when the market will be on top, that's when the greed will come in. And when the greed comes in, the price is never the wholesale price, the price is retail price. And whenever you will buy something, on a retail price, oh, you are bound to lose money. Try one thing. Well, if they allow you, go to a car showroom, negotiate and buy a car for 15 lakh rupees. They will treat you like kings and queens. They'll take care of every whims and fancy there. You pay them the money, the check is cleared, and you get the delivery of the car. Just take the car out of the showroom, and within 2 minutes, take the car back into the showroom and try to sell it back to the same salesman for 15 lakh rupees. Can you? Answer is plain no. Why? Because, you have bought it at the retail price and you cannot sell it back to him on a retail price. It has devaluated in value just by coming out. It's exactly the same into the stock market. If you behave like a customer, you will buy the retail price, and whenever you will buy the retail price, you will lose money. You will lose money into the markets here. So, there is no investment into this market. Now, let me come to a, very simple fact. There is no investor into this market. The term investment does not exist. Does it mean that the term investment doesn't exist anywhere? No, it exists. There is a term called investment. What is the definition of the word investment? When you put your money somewhere and just by the mechanism of buying it, if the profit is guaranteed to you, then and only then it is considered a investment. For example, when you put your money into FD at 9%, the moment you give your money there, your 9% is guaranteed to you and you get a piece of paper. That is an investment. You put your money into the money back scheme of LIC at 7% a year. The moment you give your premium check, your money back, your 7% is guaranteed to you. That is an investment. But when you buy 1,000 stocks of Tata Motors, are you guaranteed a 20% a year? No. The only thing you are guaranteed is a risk, because the mechanism in the stock market of profits is not a buy, it is a sell. You first have to buy, then you have to sell. Let me go back to this previous slide here. Let's say there was a gentleman who bought Unitech at 200 rupees. Very happy because it went up from 200 rupees, it went up to 550 rupees here. And he was, about 150% in profits and more. So he was very happy. But at the top here, this profit that was shown into an account was not a real profit. It was a virtual profit. It was a paper profit. If he would have booked the profit at 550, then he would have booked his 150%. But because he did not book his profit and it started coming down in price, his virtual profit also came down, and gradually it turned into a loss of about 90%. So if he sells now, he will be booking a loss of 90% instead of booking a profit of 150%, which he could have, done at 550. So the key point in learning is that holding the stock is not guaranteeing you profit. You might have stocks in your portfolio which are up. You're very happy, oh, my portfolio is up 30%. But what if a bear market comes down and goes down? If you do not protect your profits, they will erode. If you do not protect your small losses, they will become big losses, because the mechanism is sell. By buying, you're only buying the risk of the market. That's the only thing you buy, the risk of the market, which can be unlimited profits and unlimited losses. Only when you manage it, then you know whether it was a profitable trade or a loss-making trade. What is this? The mechanism of? This is the mechanism of every business in the world. Every business in the world, you buy the product at a wholesale price and you sell it at a retail price. The wholesale price is the cheaper price and the retail price is the higher price. And in trading also, you're doing exactly the same. So let's put two and two together. What is trading? Trading is a business like any other business. And all of you are traders. The only difference is the time frame in which you trade. If you buy your stock in the morning and you sell it by evening, you are a intraday trader. If you buy it in the morning and you sell within 10 days, you are a swing trader. If you buy today, you sell within 3 months, you are a positional trader. If you buy today, you sell within a few years, you are a long-term trader. But each and every one of you is a trader. Who is at a bigger risk? Many people think long-term is the safest. No, guys. Long-term is the tsunami. Let's see, you are near a beach with your family, enjoying the waves, sunset is happening. So, and you're enjoying. The waves become a little bigger, and you are still splashing. But now the waves become a little bigger. What will you do? You will come back because they have become a little dangerous. And then comes a tsunami, and you will run. So intraday trading is small risk. It is the in which you can splash. Swing trading is a little bigger risk. Positional trading is even bigger risk, and long-term trading is the most risky because here the change is the most. Let's say State Bank of India, in a day, how much will it move? Maybe 2%. So what is your worst risk? 2%. But in 10 days, swing trading, it might move 8 to 10%. So your risk has become bigger. In a positional trade, 3 months, it might move 25%. So your risk has become even much bigger. And that 25% can be in any direction. That's why the risk. If it is only in up direction, then no problem. While over a period of 2-3 years, it might move more than 50% up or down, and the risk becomes even bigger. That means the bigger the time frame, the bigger is the risk, and there's only one way that can mitigate the risk, which is by acquiring the necessary skill. Skill is the key. Skill is where, money comes from. We all make money from our skills. A doctor, a heart surgeon, practices for 5 years before he acquires the skill of open heart surgery. In the first 1 year in the medical college, he has all the theoretical knowledge about open heart surgery. He can even convince his friends he knows open heart surgery, but the medical college knows the truth. They know he has not practiced it yet. He's not skilled yet. So in the initial years, they give him only live bodies to experiment. They give him only dead bodies to experiment with. Because they know that without skill, if they give him live bodies to experiment with, he will convert it into a dead body. This is what you might do with your money if you come into this market untrained. This is a very big market. More than 100,000 crores stay in hand in our market every. In the international Forex market, more than $5 trillion change hand per day. These are big markets with big money, and everybody comes here for money. So don't you think that people who are more trained will make more money rather than people who are less trained or not trained at all? And what is the percentage of people who get trained and come into these markets? Very less. In fact, very, very less. So just by training yourself, you get that edge by which you can make incomes into this market. The facts are, anybody can become a trader. Is trading for a particular group of people, for people with finance background, chartered accountants, MBA finance? Absolutely not. I've taught thousands of people. And traders under me, they're housewives, they're engineers, they're doctors, they're chartered accountants, they are retired people, they're young people, all kind of people from all different backgrounds and all communities can become traders. So start from zero. Don't be MBA of the stock market. What's the MBA of the stock market? Manne badhu avde છે. No, be an empty cup. Because empty cup can be filled. Empty cup can be filled. And trading is an acquired skill. So everybody can become a trader. It's a business. It's an amazing business. To do any other business, you will require 10, 20 lakhs of rupees. You have to fight competition. You have to do marketing, sales. You have to have employees. And, a lot of hard work is there. But to do this business of trading, what do you require? A computer, an internet connection, and a trading account, which is mostly for free. You can start with very less capital, whatever you are comfortable. You can start with 5,000, 50,000, 5 lakhs, whatever you are comfortable with. And, you don't have to open an office. You can do it from home. You can make money in both the direction, where the market is going up or the market is going down. There's no competition here. You can trade while you're traveling. And it is, not age related. That means you can keep on trading as a business till you are 90 years of age. And this is one skill that you can pass to your next generation. Most of you do jobs. Even if you want, you cannot give your job to your children. This is important. My father was a scientist, a very reputed scientist in Indian Institute of Petroleum, but he couldn't give his job to me. I had to study and get my own jobs. So those of you who do jobs, well, teach a skill to your child so that he has one additional skill of making money in addition to whatever else he will be doing. It's a business. Do it with the seriousness of a business. You can do it as a part-time business. Most of the people do trading as a part-time business while doing your jobs. And trading is risk management. Trading is like driving. Even if you are a very skilled driver and you're driving on the road, even though you are in perfect control of your own driving, you cannot predict the road. You cannot predict the traffic. You cannot predict a bad driver coming from the front. That means even though you are good, you cannot say, I won't have brakes in my car anymore. कभी ऐसा किया है कि 15 years you're driving, you are fantastic, you are a brilliant driver, you've done races, then you go to your mechanic and say, remove the brakes, I don't need them anymore. Nobody will do that because despite all your skill, there is a risk involved into the road. Similarly, in trading also, there are two components. What are internal component, which is your own skill, and other are external components of trading, which are beyond your controls. A bad result, good result, a politician giving some statement, a war breaking out, election results, RBI policy. So all these are unexpected things that are beyond your control. You cannot control them, but you can manage the risk. So trading is primarily risk management. And then trading gives income. This is a business in which you can make money sitting from your home, or you can make additional source of income. You can make additional source of income, in addition to the job that you are doing. So, take it as a business. So don't be a dependent investor. Instead, become a independent trader. Take control in your own hand. Nobody is going to make you rich here, guys. Take control in your own hands. When you take control in your own hands, this is a brilliant business to go into. And you have many choices now. Maybe 20 years ago, your choice was only stocks, but now you have a lot of choices. Let's look at your choices. What are your choices? You can trade stocks. That choice still exists. Let's see here. Let's look at your choices. Let me write down your choices here. I can trade PNB, which is the stock. I can trade PNB 29 January 2015 put option of 200 strike value, which is a different product. You know, don't worry, guys. I'll give the recording to everybody. So even if your connection is a little weak, some of you are working on weaker connections, you'll still have the recording. Would be perfect. So just listen to this one, and I'll give you the recording to everybody. So here now, what is my other choice? My other choice is I can go into PNB and I can, let's note down, I can trade a future of PNB. What is my another choice? I can go in derivatives, and instead of trading a stock future, I can trade an index future. For example, Nifty, which is an index future, I can trade a Nifty future. I can also trade a option of Nifty, a call or a put, let's say. Let me first note down and I'll explain what the choices are. I can trade a future of Nifty. I can trade a Forex pair. For example, USD INR pair, where I'm trading the currency of one country against the currency of another country. And I can also trade commodities. I can trade crude oil. I can trade gold. I can trade silver. And I can trade copper and many other commodities. So that means my choice is not restricted to, stocks anymore. I have stocks. So let's understand these products. PNB is a stock, and similarly there are 5,000 stocks combined together on BSE and NSE. And a stock is primarily used for positional and long-term trading, because you can hold it over long periods of time and it involves less risk. So you can build portfolios out of stocks. And since futures and options are available only in 150 stocks, in the remaining one, you can start finding value. You can start finding value on this. Then your another choice is a stock future. Stock future is a limited time product. You can buy near, next, and far. Like this PNB 29 January 2000 future, would expire on 29 January, but it's a leverage product. What does it mean? In this product, I can make money. Guys, is it okay if I increase the session by about 15 minutes so that I can cover everything? Because I see that I will not be able to cover it till 1 o'clock. Is it okay for most of the people? So I don't have to, squeeze it. Thanks, guys. Okay, so this is a leverage product in which I pay, only 20% of the money. That means it is an 80% discount product. And I can trade it in both the directions. For example, if I look at this PNB 29 January, this is a lot size of 1250. So if I look at the Friday move, let's say on Friday, PNB came down from a high of 209 and closed at 206 roughly. So this went down about 3 rupees. So in a stock, I would have lost money. But if I was trading a future and I was trading the short side of the market, that means I was trading the future short. On the same day, I would have made about 3,500 rupees into PNB. And the capital required would have been much less. Instead of the regular, about 2.5 lakh rupees that I required, I could have traded the future with just about 50,000 rupees. That means on a single day, there's a profit potential of about 7%. There would be about 7%. So this is an income product. Now future is not a portfolio management product. लोग मुझे पूछते हैं सर हम future से portfolio management कर सकते हैं? No. You use the gun to fight the battle. and you use the knife to cut your vegetables in the kitchen. So you have to know what product to use where. Now, this is a great intraday and swing trading product because the advantage that I have with a stock future is that with a 1% move in the price of the stock, I can make 5 times more money because it is a leveraged product. It's a leverage. And I have 150 stocks to choose from. That means every day there would be a trading opportunity either in up or down. And since when you know how to trade futures, you are independent of the direction of the market. People ask me, sir, आपको क्या लगता है मंडे को मार्केट किधर जाएगा? Where will this market go on Monday? And I say, well, it's simple. It will either go up or it will go down. But it will open for sure. If it will go up, I'll try to make money going long. But if it will go down, I'll try to make money going short. But I have the opportunity to make money in both the directions. And that's the beauty of the future products because you're no more direction dependent. You can make money, in both the directions and make it 5 times faster. That means आपका 5 times, you can make it faster. कितना time बच जाता है? The same money that you can make in 4 hours or 5 hours in a stock, exactly the same amount of money you can make in just about 1 hour in a stock future and with much less capital. So now you can also trade index futures. The two very popular index futures are Nifty and Bank Nifty, and these are, a 90% discounted product. 90% discount. Well, a lot of people trade Nifty or they have interest in Nifty. Let's look at this product here. Let's say this was Nifty on a Friday. It went from 8475 to 8535. It went up by about 50 points. So 50 points, the lot size is 25, is roughly about 650 rupees of profit. On a good day when Nifty goes up 100 points, which is does many times with a ATR of about 129, you can make 1,250 rupees on a 50-point move. On a 50-point move, you can make 1,250 rupees, not 650, sorry, I stand corrected there. And on a move of 100 points, for example, Nifty just went up 200 points in a day. On a 100-point move of Nifty up and down, depending on the direction you have bought, you can make 2,500 rupees. That means every time Nifty moves 100 points up or down, you have a chance to make 10% on your capital because the margin requirement in the Nifty is only 21,000 rupees. It's a 90% discounted product. Similarly, you can trade Bank Nifty, in which 100-point move gives you, 2,500 rupees. Capital requirement only about 40,000 rupees. And just a few days ago, in a single day, Bank Nifty moved 700 points. That means there was a chance to make 20, 30, or 40% in a single day on Bank Nifty in a day. And over a period of days, it can be a lot of money. Then you can also trade options. Options are very, very profitable products. And in option, the leveraged component is very high. The beauty with options is your downside is limited to the premium that you pay. And your upside is unlimited. For example, this PNB in the morning, which went up 38% in a day, in the morning you could have bought this with just about rupees. If you bought the same number of stocks, they would cost you about, 2,50,000 rupees. The same number of stocks in the futures market will cost you about 50,000 rupees. But in the options market, you can control the same number of stocks with just about 2,000 rupees. And what is your worst case scenario? 2,000 rupees. What is your best case scenario? Unlimited. That's why so many people, come into options. A brilliant product to trade, which can also be used to hedge your portfolios. And it can give you money in up direction. It can also give you money in the down direction. For example, if I look at this Nifty, the stocks, like on Friday, Z Limited went up 4%. So let's look at Z Limited. Z Limited, very good. Somebody was happy. My stock went up, 4% in a day. But let's see if instead of the stock of Z Limited, you were trading the call of Z Limited. Let's see what happened to the 350 call or 375 call. So I go in the same stock, I go to Z Limited, and I look at calls here, and I'm looking at, let's say, 370 call. And I add the 370 call in this. And the 370 call in a single day went up 106%. So in the stock, you would have made 4%. But if you were trading the stock future, you see, you would have doubled your money in a single day. And this you would have purchased at a very, very low cost. So, that's why it's very, very important to learn options. They're used for hedging your portfolios, and they're also used for trading very, very profitable products. Another product you can trade is Forex now. It's a huge new big market coming in India where you can trade the currency of one country against the currency of another country. And to trade one USD pair, how much money do you require? Oh, just 1,500 rupees. That's all you require. The good thing with the products is they are much, much, much cheaper than the stocks. Stocks are used for positional and long-term trading, and for intraday and swing trading, mostly stock futures, options, Forex futures, and commodity futures are used. Then you can trade commodity market, and this market is open till 11:55 in the night. Stock market opens at 9 in the morning, it closes at 3:30 in the evening. Indian Forex market opens at 9 in the morning, closes at 5 in the evening. But the, commodity market opens at 10 in the morning and is open till 11:55 in the night. And here all the products have a 95% discount. And that's why the amount of money that can be made here is too much. It's too much. A lot of money. But then when you are trading, the risk is also there. If the upside is 100%, downside is also 100%. So you have to have the necessary skill to know which direction it is likely to go. You can trade crude, you can trade gold, you can trade silver, you can trade copper. Because if I look at copper, let's take this move of copper. Like here, this is copper, and this is a single day move of copper. Let's see this move. How much money do you require to trade copper? Maybe about 20,000 rupees. That's all. 20,000 rupees to trade copper. And what is the calculation? If you catch 1 rupee move in copper, you get 1,000 rupees. So this move from here to here is a move of about 8,000 rupees. This is an 8,000 rupees move in how many hours? 1, 2, 3, 4, and 5 hours. In 5 hours, 8,000 rupees of profit on a capital of 20,000 rupees. I'm talking of 40% profit in just a few hours. Isn't it worth learning? That's what I ask. Isn't this worth learning? Even if it takes a few months to learn a skill like this, it would be worth it. All the charts I'm opening now are technical charts, guys. These are candlestick charts I'm opening in front of you. So, we have huge, big number of choices now. Our choices in this market are huge. So let's revise. You can trade stocks, primarily used for positional and long-term trading. You can trade stock futures. You can trade index futures, options, commodities, and Forex, which is used for intraday and long-term trading. And you can also trade international spot Forex. But before you buy, before you go to buy anything, long or short, you have to answer 5 questions. If you don't answer these 5 questions, you cannot go into a trade. If you don't have answer to all the 5 questions, please do not put 1 rupee of yours into the stock market. And you need to train yourself to answer these 5 questions. Question number 1, what to buy? What to buy? You have limited money. Market has lots of opportunities. You cannot put all your money on all the opportunities. That means you have to find, out of all the opportunities available, which one is the high probability opportunity. And that high probability opportunity is what you have to learn how to buy. So out of the 10 stocks, which is the one which is the high probability trade, which is fundamentally strong? Fundamentally strong. If you are buying a long position, you want to make money going up, then you are looking for fundamentally strong stocks. But if you are planning to make money by shorting the market, then you are looking for fundamentally weak stocks in downtrend or fundamentally strong stocks which are retracing and profit booking is happening. So what to buy? Second, when to buy? And when to buy is very important because this market is emotion driven. In this market, the book value is not traded. The book value of the balance sheet is not traded in this market. It is a market value that is traded. What is market value? The last transaction price between the buyer and the seller, which is very different from the book value of the stock. And it is primarily driven by greed and fear. When the greed comes, the market value expands, and when the fear comes, the market value contracts. Abhi, just a few days ago, our market crashed 250 points on Nifty in a single day. Nothing changed in fundamentals. What happened? A huge fear came. On the day when the RBI policy was announced, a few days ago, the market went up 250 points in a day. Why? Because suddenly greed came. So this fear and greed will help us to a market. Let's see here. For example, let's take a fundamentally strong stock. You might not have heard the name, RS Software. A fundamentally brilliant stock to buy. Nice P values, great EPS, working fine. So if I look at this stock here, so this stock here was going up and up, and just in a few months, it went from 155 rupees to 800 rupees. And now from 800 rupees, it is now back to about 600 rupees, came to a low of about 475 rupees. So even though fundamentals have not changed in 1 year, fundamentals have not changed in 1 year, but when the greed came, the price went up. When the fear came, the price contracted. So you need to learn how to time this market, how to get in here and get out here. Then how to stay out of the market in a downtrend and again enter when the downtrend is finishing and the uptrend is starting. That means you have to learn how to time the market. So timing the market is another skill that is very important. It will tell you when to buy, how much to buy. Most of the people who suffer big losses are the people who violate the rule of position sizing. The broker is saying, sir, buy it 20 times. I'm giving you a 20 time exposure. And they buy 20 times. They don't realize that if the move doesn't happen in my direction, my loss will also be 20 times bigger. So you have to know how much to buy, which is well within your risk-taking capacity and how much risk to take. You are taking a stock for 1 lakh rupees. Have you calculated? Will I take 1,000 rupees risk or a 2,000 rupees risk or a 5,000 rupees risk? Till the time you have not quantified your risk, you should not start your trade because you have equal chance of going wrong. So how much risk to take, and very important, when to get out. People think to get out, you only have to get out when you are in profit. No, you also get out when you are into a loss. You also get out when you're in loss. And that's the reason you have to learn these 10 critical components of trading. These are the 10 components of trading, which if you learn, takes a few months, you know, you will be able to find out what to buy, when to buy, how much risk to take, and when to get out. And if you can do that, you can trade all, asset classes. You can trade stocks, you can trade futures, you can trade commodity, you can trade Forex, you can trade options, all the assets you can trade. So the first critical component of trading is chart trading. Chart trading with technical analysis, which will help you to time the market, when to buy. Then stock selection with fundamental analysis, learning how to read the balance sheet, understanding how the management works, the quality of the product, how this sector will do. All this come under the fundamental analysis. Fundamental analysis is not only balance sheet studies, it is more than that. Then you need to know, out of all these opportunities available to me, which one is the high probability opportunity. What is a high probability opportunity? It's got many qualities. One of them is it has minimum 3:1 reward to risk ratio. What is a 3:1 reward to risk ratio? It's a trade in which if you're wrong, you will be wrong for maximum one time, but if you're right, you'll be right for minimum 3 times. Is every trade a high probability trade? No. Only few trades are high probability trades, which can be found with technical analysis and fundamental analysis and with stock filtering. And the beauty with high probability trades is that you can half the time and you will still make money in them. And that's what is very important to understand, because mathematics doesn't lie. I'm an IITian and we have been taught mathematics is a language that doesn't lie. And let's understand how. Let's say in a whole month, you have taken 10 trades, all high probability trades with minimum 3:1 reward to risk ratio. Each trade is with proper entry, target, and a stop loss. And every time you're wrong, your stop loss is hit. And every time you're right, your target is achieved. So when you are wrong and your stop loss is hit, you lose 1%. But when you're right and your target is achieved, you make 3%. 5 trades you're wrong, 5 trades you are right. So in the 5 trades in which you're wrong, how much do you lose? 5%. But in the remaining 5 trades in which you're right, how much did you make? 15%, 3% in each. So net, even though you were wrong half the time, you still made a 10% because you were practicing high probability trading with proper risk management, with correct entries, exits, and stop losses. That's why you should spend a lot of time learning and trading only high probability trades. Then risk management is the key. Every trade will have 5 possibilities: a big profit, a small profit, a small loss, and a big loss. Your biggest enemy in this market is a big loss. Those who have portfolios, and if your portfolio is down, isn't that a few stocks which have given you big loss, they're dragging the whole portfolio down? And wasn't that big loss at some stage a small loss? No loss is a big loss from the start. You allow your small loss to become a big loss. That means the first thing you have to practice is to ensure that your small loss does not become a big loss. That your small loss does not become a big loss. And for that, you practice proper risk management, stop losses, trailing stop losses, position sizing, right RR ratios, and many other methods. So when big loss is taken out from your system, small losses and small profits will take care of each other. And what you can concentrate on then is the big profits and the high probability trades. And that's how you will create incomes over long periods of time by practicing all forms of trading. People say, sir, which form of trading should I practice? And I always say all. Because in different stages of life, you will have different situations. And in different situations, you might have different needs. So why not learn all four styles of trading? Then fifth is mastery of online platforms. We are in a age now where trading can be done automated, where you can, tell a computer to execute your commands, but unfortunately, the computer can't think for you. So you have to master the online platforms. High probability trading techniques. Market is not the same all the time. Sometimes it's a roaring bull market, sometimes a depressing bear market, sometimes a frustrating sideways market, sometimes a gapping market. So, expanded range candle market, sometimes a doji market. So all kind of markets are there. You need to have high probability trading techniques aligned for different kind of markets, different kind of products. And that's an acquired skill which can be learned. And you need to have a trading plan aligned to your personality. It's a business. The way you cannot do a business without a business plan, you cannot do trading without a proper trading plan approved by your mentor. Ask yourself, do you have a trading plan approved by your mentor? And is it revised on a regular basis? If the answer is yes, well, you'll become a trader. If the answer is no, you need to make one. You need to train yourself and make a proper trading plan. Next skill is decision-making training. In this business, you don't have to manufacture anything. You don't have to give any service. You don't meet customers. You don't make sales calls. You don't do servicing. What do you do? In this business, you do decision-making. This is a business of taking decision. Every time you have bought or sold a stock or a future or an option, you have taken a decision. And if you do emotional decision making, you are ruined. You need to learn how to do rational decision making, not emotional decision making. You can do, rational decision making. And when you are you have taken a trade, you are expecting profits, and instead it starts getting down against your plan, and you take a small loss, it is a rational decision. But if you allow that small loss to become a big loss in the hope that someday it will go up, that is a emotional decision. If your trade starts moving in your direction and you're moving you're making a 3% in the trade, and instead of booking the profit, you decide to trail it to cost so that it can achieve its full potential of 15%, you are practicing rational decision making. But if you're scared that your profit will go away and you book your 3%, you have done emotional decision making, and after that it moves to 15%. So you have to learn how to practice rational decision making into this market. Then money management and trade, very important component of trading. Any business requires optimum utilization of capital. For example, there are two traders who have 1 lakh rupees. One of them is untrained, only knows buy and hold, and he puts his money into a stock and waits for 1 year. So he has just utilized 1 year without a plan. Other trader is a trained intraday trader. He trades, with 1 lakh rupees, he trades 4 nifties per day. And 1 nifty is about, 2 lakh rupees of turnover. That means every day he trades for about 10 lakhs with the same 1 lakh rupees. And in 20 trading days, he utilizes about 1 crore of capital, and in the whole year, maybe about, 10 crore rupees of capital. So with the same 1 lakh rupees, he knows how to, expand your money and how to rotate the money. So if you want to become a good trader, you have to learn how to expand your money by using the leverage products and how to rotate your money by moving it in and out. So money management and trade management, every trader should have a proper trade log that he should be working with. And last, And very important, managing emotions and your subconscious mind. In the classes, I teach you meditation, trading meditations. And in trading meditations, you will be able to access parts of your subconscious mind which will help you to understand yourself better and understand your trading decisions better.